Hello students, welcome back. So we're going to begin our next section by talking about the costs of production. So we spent a lot of time analyzing supply and demand together, but we haven't talked specifically about those factors that contribute to a seller's decision to supply and sell a particular good. So we know supply and demand and market forces. We've worked through that. But in particular, we want to spend some time thinking about how it is that firms are willing to produce and sell a greater quantity of the good when the price rises. It's actually not so obvious that just based on price alone, that sellers should be willing to sell more of a good. I mean, obviously, there's something to do about their capacity to supply the good. I mean, if the good is just a fixed amount of something, suppose you've picked so many tomatoes and that's all you've planted for the season, it doesn't matter how much the price rises, you just can't supply more. So if you're planting more long term and you see a higher price and you think it's going to last, maybe you'll plant more tomatoes next season. But when we're talking about regular goods and services that you manufacture, we really want to dig deep into the motives of the sellers and see that by selling more of the good when the price rises, they actually are able to generate more profit for their company. So our goal is to explore that. And first we start with the objective of all businesses. From an economic standpoint, we assume that all businesses are solely in business to maximize their profits. So we have to go ahead and define profits precisely to begin to analyze their decisions. So we start with total revenue. That's the amount of money that a business brings in from the sale of its goods. And they also have to consider what their costs of production are. So we consider their total costs. And remember, we talked about it a little bit in lecture, but when we're talking about costs, we're going to specifically focus on the opportunity costs. And we'll talk a little bit more about that in a minute. But it's important because it's not just accounting costs. So profit is the difference between total revenue and total cost. It's the amount of money the firm brings in from selling its goods and services minus its costs of production. So again, now we'll meditate a little bit on what we mean by opportunity costs, because we divide our costs up into two categories: explicit costs and implicit costs. And they both are different types of opportunity costs that the firm faces. So opportunity cost is a bigger concept than either explicit or implicit costs. So the explicit costs are the ones that you would normally think of. They're things that the business is going to have a receipt for. They generate a cash flow. So if you look at the definition here for explicit costs, it says explicit costs are the input costs that require a direct outlay of money by the firm. Implicit costs have to do with decisions made by management about how to use their resources. So the best example is idle equipment. So if a firm has a big bulldozer and it's paid off, it's not generating any cash flow, they don't have to make any payments on it, and they're not using it, then they're foregoing the opportunity of renting that big piece of equipment and generating a cash flow. So if they just leave the equipment idle or still, right, they don't do anything with it for a long period of time, then you're not going to see a receipt. It's not going to be an explicit cost, but obviously it in some sense represents a poor management decision to leave that equipment idle if they could be renting it out and generating a cash flow. So those implicit costs are ones that economists are really good at pointing out, and that's why economists are good at strategic management. So if you want to think about these a little bit more clearly, when we talk about profit, we're really going to focus on economic profit, which is the difference between the money the firm brings in minus its total opportunity costs, including both the explicit and implicit costs of the firm. Accountants, on the other hand, are only interested in tracking cash flows, so they ignore the implicit costs. So accounting profit is going to be total revenue only minus the explicit costs of the firm, and that's going to mean that accounting profit always is higher than economic profit. One of the things that's going to come up in a little bit is we're going to talk about a prediction that economic profits are zero in equilibrium, and that throws students off a lot of the time. And it's because they think, well, how can a company stay in business if it's not generating any profit? Well, remember, that's economic profit. So from an accounting perspective, the firm would still be earning a profit. They're just not counting those implicit costs that we do. They're not counting the full opportunity costs. So you can see a firm that has a positive accounting profit and they can still have a zero economic profit. So when total revenue exceeds both explicit and implicit costs, then the firm is earning an economic profit. And remember, economic profit is always smaller than accounting profit. So from an accounting perspective, if the firm's earning economic profit, it's earning a positive accounting profit and then some, right? And remember, for firm, right, we mean a business firm. So for accounting profit, remember, we're just considering how it is that once we take revenue and we subtract off explicit costs, how much is left over. That's accounting profit. But we have an additional amount of implicit costs when we're looking at things from an economic perspective. So that should help you get a good visual of why it is that economic profit is always smaller than accounting profit. And again, here we highlight that we count total opportunity costs. So whenever you hear costs in this class, even though a lot of times we'll point out explicit costs, we mean implicit costs too. It's just that it's easier to talk about explicit costs. So here's a good example. If you look at this table, it has a relationship between the output at a bakery and the number of cookies that are produced and the number of workers that they hire. The number of workers are generally assumed to be a variable input, meaning they can vary with the amount of production. You hire more workers, you get more output. So notice how as you hire more workers in this table, you go to higher and higher levels of output. And then we have this concept we call marginal product. Now, marginal product is going to be the additional amount that each additional worker brings in terms of total output. So here you can see that the first worker generates 50 units of output, and the second worker brings an additional 40 units of output. So that additional output for each additional worker, that's the marginal product. And in this case, since we're talking about labor, it's the marginal product of labor. And then we have these other costs over here, which is the cost of the factory. Notice the cost of the factory is constant. It's like some rental payment for the location, and as long as you're within the capacity of the location, it won't change. Then we have this variable cost component, which is the cost of paying the workers in this example. And if you add those together, you get the total costs of all inputs, the factory plus the workers, in the last column. Okay, so in order to talk about why it is that firms produce more output when prices rise, we have to talk a little bit about their capacity to produce. So we introduced this idea of this production function, and it shows the relationship between the quantity of inputs used and the quantity of an output that's produced. So what we're going to do is we're going to focus on the marginal product, which is going to be how the production function changes its slope as more and more of the variable input is used. Obviously, since the factory is fixed, it doesn't make sense. You just have one factory and different levels of output to try to graph factory against output, because you'll have you won't have a standard sort of graph if you do that. But the big idea is that when firms produce more and more output, each additional unit of a variable input, in our example, we're going to talk about workers most of the time, is each additional worker brings less and less output to the firm. And we could talk a lot about why that happens, and the gist of the idea is that since there's a limited capacity at the factory, a limited number of machines, then as you have more and more workers, then there's less and less equipment for them to work with each additional worker. So you might think that, in the beginning you have 3 machines, and so 3 workers can be very productive, but the 4th worker might help a little bit, but maybe he's just going to give breaks to the first 3 workers, or he's going to be cleaning up after them. And then so that 4th worker won't contribute as much to output as the 3 previous workers. It's that idea of having some fixed input, what we call a fixed factor of production, that experiences some sort of congestion as more and more of a variable input is used with it, that leads to this diminishing marginal product. So let's go ahead, and we're graphing the production function here, the number of workers hired against the levels of output from the table that I just showed you. And so you can see the first worker brings 50 units of output. With 2 workers, you have 90 units. So that second worker is bringing an additional 40 units worth of output, and so on. And so what you see in our graph, again, is this idea that the slope of the production function is going to decline because each additional worker is going to bring less and less output to the firm. So I'm going to go back to that graph really quickly so you can take a look and see. Again, here as we're increasing the number of workers, notice that the slope of the production function is getting flatter. So that kind of shape is typical of what we see for most businesses that produce, is they use more of a variable input. Each additional unit of variable input leads to less output, and so you have this flatter and flatter slope. So it looks like the production function's wilting toward the x-axis. It's leaning more and more in that direction. Okay. So the relationship between the quantity a firm can produce and its cost determines its pricing decisions ultimately. So now we have this idea that each additional worker is going to bring less output, and that's going to somehow factor in, we haven't talked about it yet, with the firm's decision to hire additional workers and to produce more output. So the total cost curve is how we represent that relationship graphically. So we'll go ahead and we'll go back to the table that we saw before, and we can see the first 3 columns have the number of workers and the production data, and the last 3 columns, as we talked about before, particularly the last column, has this total cost of production. And so we can relate the total cost of production, what's in the last column, with the quantity of output, and we can graph that, and we get this total cost curve. And so you can see, and it's kind of hard unless you go back and you look carefully at the slide, but the relationship, because each additional worker is generating less and less output, it causes this increasing total cost of production as you push the quantity of output higher and higher. So this increasing total cost is a direct result of the diminishing marginal product. And I'll say that one more time. Increasing total costs is a direct result of diminishing marginal product. And so we're always, as long as we have diminishing marginal product, we're going to see this upward sloping total cost curve. So now that we're going to talk a little bit more about costs and try to dig into how it is the firm decides to produce more output when the price goes up, and you guys can kind of see, if you're thinking about it, that if they have increasing costs, they really need a higher price to justify producing more output. So we're going to focus in on the costs now and talk about them for most of the rest of this lecture. So the various measures of costs that we've discussed so far can be divided up into fixed costs and variable costs. Fixed costs are those costs that do not vary with the quantity of output produced. And variable costs are those costs that do vary with the quantity of output produced. So we can come up with a couple of equations that relate these ideas. And so we're going to refer to total costs, and generally total fixed costs and total variable costs, add them together to get total costs. And it depends upon the context. A lot of times we'll drop T from the front of the fixed costs and the variable cost, and we'll just write an equation that has total cost equals fixed cost plus variable costs. And implicit in that, it's the total fixed costs and the total variable costs, if we haven't said anything different. So now we're going to go ahead and look at another example. And here we have quantity of output per hour and the total costs of producing more output. And we've dropped the production data except for this quantity of output. And we're relating it to total costs, total fixed costs, and total variable costs. And we're going to distinguish those concepts from the average of the fixed costs and the average of the variable costs and the average of the total costs. And then lastly, we're going to talk about this idea of marginal costs. So for this lecture, I'm going to go ahead and stop there, and then we'll continue on with this example in a coming lecture.